Hi, my name is Jim Hilborn,
And I'm Tom Dinas.
and we
Oh, the
small business doctors.
And I've been taking care of business every day. Taking care of business every way. I've been taking care of business. It's all mine. Taking care of business and working overtime.
Hi, my name is Tom Dinas, and I'll be talking today about what is a deduction. And with me is my partner in crime for most of the capers I pull off, Jim
Most of them.
Hilborn,
How are you? How are you
attorney
doing
at
tonight, Tom?
law and convicted felon.
That's
oh,
right.
No, that
oh,
was,
no,
that-
not convicted.
Oh, that's right. I was overturned.
That was
I'm sorry.
completely a huge misunderstanding. That's right.
Yeah, that Twitter account thing.
Yeah,
That was
yeah.
no. Anyway, the topic I've chose for this evening is pretty mundane in some ways, but it's
We could do 30 minutes on Twitter.
yeah, we could do 3 minutes on how to embarrass yourself in front of the world.
Exactly.
But we'll refrain from that because we have good taste.
We have business to do. That's right.
Yeah, but anyway, the topic, although seems a little basic, it is. And
Oh, it is
it's the
very
thing-
basic.
Yeah, and for people that are just in the business or who are thinking of starting the business, it's something that is going to come across your mind because you're going to hear lots of very weird things
You
about
are.
deductions.
Exactly. The magic word
Yeah, and what's the biggest illusion or confusion out there, or misinformation?
that a deduction is 100% taken off of your gross income. Exactly.
Wrong. Yes, let's talk marginal tax bracket. People who are not in business for themselves have this, I don't know where the myth came from. Oh, you can deduct it, so it doesn't cost you anything.
That's right. If you want to give $100 to the Boy Scouts, which you may,
Mm-hmm.
but then this is a charitable deduction. You can deduct this.
Yeah, or you buy that piece of equipment, so you're not, didn't cost you anything because you saved all that in taxes.
Uncle Sam
Okay.
bought it for you.
Uncle Sam bought it for you. Now, Uncle Sam will pay for some of it, but what is calculated is called the marginal tax bracket. As you go through the income earning process, the first X amount that you earn is no tax on it whatsoever, zero tax.
So that's
you
your
get-
bracket.
Yeah,
Zero tax.
zero. And then you earn a little bit more, and then they take 5%, and then they take 10%, and it goes up to 15 and stays there for a long, long time. Then it goes up to 25, and then if you really start getting to be a heavy hitter, it goes up
To
above
1/3.
that. Yeah,
Right now.
yeah. That's not counting state and local taxes.
No.
So that gets added on. But just because you're in a different tax bracket does not mean all your income has been moved up to that bracket. You still get that first chunk at 0, the next chunk at 5, the next chunk at 10, et cetera, et cetera.
Exactly.
So, but there is no 100%. So when you buy something for your business or you expend something for your business, what you save is that marginal rate, the last dollars that come in.
Exactly.
And if you're in the 15% tax bracket, you're going to save what?
I'm going to guess 15%.
Whoa, can tell you got a college degree.
That's
Wow,
right.
They taught you in the law school that?
No, they didn't.
You learned that out in the street, didn't you? So anyway, so people, I built this template that I'm going to introduce to clients in the future, and it's a little thing where you put your marginal tax rate in it, and then you expense. And I have clients sit down, and I was beta testing it with them and see how they liked it, and they go, "Wow, that's not much tax savings for as much money as I put out."
Exactly.
And that's one of the things you have to realize. That marginal tax rate is what you're going to save, not the whole amount. So if you spend $1,000, you're going to save $150.
At the 50, yeah, at the 50,
Maybe
exactly.
maybe 200. When you add on the state and local
Right.
bill. So it helps.
Sure.
And the higher bracket you are, the more it helps. But even if you're at that high rate, let's say you're at 32%, your state is 8%, so that's 40%.
40%.
So you're going to save $400 on a $1,000 purchase.
Yeah.
It helps a lot, but it doesn't save it all.
And it is no reason to initiate most business decisions. It
Oh,
may be-
God, no. Yes, yeah. Do not make business decisions based on tax savings, period.
Period.
If you get nothing else from that, all the stuff Jim and I have put out here for educational videos for small businesses, that should be one thing that you come away with.
Income is good.
Income is good.
Even
Yeah.
if they take 99% of it, it's the last
Well, I don't know
bracket.
if they take 99%.
Well, for example, though, it's even if they take 9%, you still get the 1% left. A deduction, you don't.
Right.
And so,
It's
and
cash out of your pocket.
that's right.
And I've had clients over the years, and they will buy some of the damnedest equipment. Oh, I got a good deal on it, and plus I needed the tax deduction.
I needed the tax deduction.
And what are you going to do with this piece of equipment? I might be able to use it on this or that or a job, and then it just sits there, collects dust, and and then becomes obsolete or whatever. And basically, they've lost money on the deal.
And using that construction analogy, had they taken a rental for that 1 or 2 jobs a year, they could have actually deducted 100% of the cost of the equipment as a rental, as a cost of that job.
Yeah, but still, only saving.
But it's still
margin.
at the bracket. Yeah.
But they could have taken the $10,000 and put it into IRAs for them and their spouse, and have a lot more money in your pocket.
In your pocket.
At the end of the day than doing something like that. Only buy equipment and tools and supplies which will generate you revenues. Do not speculate on equipment purchases. I've never seen it
Ever.
go well. Never.
The people that you're buying the equipment from, they do okay.
Yeah, that's the guy you want to be. You want to be selling that equipment.
That's right. You don't. That's right.
Okay, and now when we're looking at this marginal bracket, though, it gets a little convoluted based on the type of business that you are.
Okay.
Now, your business entity, and we go into this in one show.
We have a show on
very, very
Tom and I have a
detailed.
show on that. Yeah.
But, and so what you have is if you are an LLC and just being treated as what's called a disregarded entity, if you're a single member LLC, you're a sole proprietor, multi-member, you're a partnership. So if you have one of those 2 business entities, your marginal rate is a little higher because when you make a deduction, it also reduces your taxable Social Security base. So you add another 13% on top of whatever your your marginal rate is. Now, if you're a corporation and you're taking out a salary, it gets a little dicier, because you have to make some decisions. If there's not enough money to go and do both of them, maybe you have to reduce your salary. And if you're an S corporation, it's a pass-through entity, and so it doesn't affect Social Security currently, although the IRS would like to change that.
Yeah.
But so anyway, Jim and I always advise, you get professional opinions and you need an accountant and an attorney on your business team.
On your business team.
Because we cannot cover every possible contingency that might, you might be involved in.
That's
Because
right.
there might be something else that kind of comes in there. In tax law, it's like you grab something and something else squirts out on you.
And they may change it tomorrow too. So.
Yeah, well, they will. It just matter which way it goes. And then there's 2 different types of deductions. There's personal deductions and the business ones. Now, the personal ones are more dicey. I mean, there are medical ones. You got restrictions. You can't take the first 7.5% of your income against it. And there's certain miscellaneous deductions. It's 2%. And there's there's alternative minimum tax, and that might come into play on certain things if your itemized deductions are too high. And we're not going to deal with that. Just be aware that you have to plan around some of those things, and you have to get if you're going to be making major investments in something, you need to have somebody analyze it for you and see just what happens.
Exactly. Exactly.
But now business deductions, they're golden. You get that no matter what, as long as they meet the criteria of what a deduction is as defined by the Internal Revenue Code.
Those guys.
Those guys.
And
Yes.
what is a deduction as defined by the Internal Revenue Code,
It
Tom?
is-
If you know.
Well, I can throw up or regurgitate what the law says. One, it has to be ordinary and necessary. Seems reasonable enough. Ordinary means it's something that happens within your business on a regular basis. So if you're a contractor and you're buying, hammers and small tools or whatever,
Yeah.
that's an ordinary item in that business. And it's necessary, so it meets the
Sure.
criteria. Ordinary, necessary, hammers, nails, power
that stuff,
saws,
yeah.
whatever. That's all good. A 52-inch color TV for your office. Now maybe we have a problem.
Right.
Because is it ordinary? No. Is it necessary? You might make a pretty weak case for that, but probably not. And then there's also, it must be reasonable.
Yeah.
So if you have an entertainment expense and you take out a couple, your builders that you want to, or customers that you want to woo and try to get their business, and you take them and you say you have a $200 or $300 dinner bill,
Sure.
ordinary, necessary, and reasonable.
Yeah.
But if you took them out and spent $5,000 and, line them up with girls or whatever, you look at it and go,
What a sexist statement that was. I mean, how inappropriate. Good Lord.
ordinary, necessary, but it's
Back
not
to
reasonable.
Chicago for you, huh? All right.
But anyway.
Not necessary or reasonable, yeah.
Then the IRS might throw out that type. If they say it's lavish in nature, they can throw it out.
think
Now,
they
I
can.
don't know how
Who
they
would
can
know?
make.
Maybe
who
not
knows?
in Washington. Yeah.
Yeah, I read about what some of these big corporations do for their shareholder meetings and what they do for their board of directors. They'll fly them to some place.
Yeah, it just makes your jaw drop
Yeah, I mean they're spending tens of thousands of dollars
on shareholder money.
Yeah, shareholder money. I don't know how they do that. And then the other issue with expenses, you have to keep some records on it so that you can substantiate the expense.
That's right. That I
Now
guess.
that's the core of what is deductible. And you go, Tom, I just paid you all this money to come in here. You ain't told me a damn thing yet. Ordinary, necessary. What does that mean?
Well,
So what I did,
there's a grandmother rule. What would your grandmother say?
oh, that tough old little Polak boy, she
Exactly.
she'd get in your face over a dime.
That's right. You didn't need to do that. So that's you. She could have been a tax collector, see?
Oh man, the government would not be in the trouble it is today if my grandmother.
Be sure that their investments would be doing well.
Yeah.
Well, I will tell you this: without the expense vouchers, without your receipts, and it's pretty easy to do with credit cards these days, or debit cards, that if you have a proof of that you spent the money, and you're claiming it as a business, and you correct me if I'm wrong, but and you're claiming it as a deduction, and the government says no, Nanette, that doesn't work for a deduction. It's not reasonable, necessary. It's certainly not tax fraud. We can disagree about whether or not it's reasonable and necessary, but we got a receipt and we claim it's for business purposes. Yeah. They're not going to say it's not for business purposes. They're just going to say it's not reasonable and necessary.
Yeah.
Right.
And I'll tell you, I got really good news for people. They're
Good news.
wrong a lot of times.
Okay.
And you can fight.
Yeah,
The question is,
exactly.
how big is the fight worth?
That's
Like I
right.
used to tell my kids, choose your battles. You only have so many fights in you in life, so choose them wisely. If it's over $50, pay the ticket and leave.
Yeah, find your hill to die on. Yeah, I mean,
but
that's
if it's $1,000, maybe we want to go one level and appeal it.
and they kind of know that too. I mean, they kind of know where the appeal's at, and those guys. They're reasonable people. They obviously will make concessions as well.
Right. So now, I made out this so even you can do it, Jim. We're going to go through my laundry list of expenses because that's what my clients really want to know.
I'm not going through this laundry, folks. I'm telling you that right now. But all right, laundry list of deduction. Okay.
We start with A.
All right,
You
A.
got that one?
Got that. Advertising.
Funny you should mention that.
Is it?
I have to
Okay.
teach this guy everything. Oh, my God.
I can help
What an
with that. I'm good at
embarrassment.
that.
Yeah. Okay, advertising. Things you put out for news media, television, radio. But your Uncle Fred's going to say, no, you make a sign with your business name on it and you slap it on the side of your car and then you deduct the car.
That's what he's going to say. That's right.
And they've been saying that for years. I would thought that myth would have disappeared, but myths,
No.
urban myths and tax myths are like cancer. It just
they just
stays
keep
there and
going.
festers. But all other
Much like zombies.
no zombies, yes.
We did a show on zombies, but yeah. Okay, so advertising. So what is the key on advertising? Is there one?
No, because there's no way they can fight that one. You know, it's ordinary, necessary,
Okay.
and even if they consider it lavish or excessive, maybe you're shooting for the moon. And you know, and it's hard to say at an unrelated third party. I mean, if it was your mom's advertising company, maybe they'd look at it a lot closer. But if it was a normal third-party transaction, there's no problems with that. You know, you're not going to have issues. I have yet to ever see the IRS even question any type of an advertising, as long as it was, you know, as long as you had receipts on it. Once again, the paperwork.
Okay, quickie on the car. Can you do it on the car? Really? I thought you could.
Well, you can deduct the sign, but
Okay.
you can't deduct the car
Man,
itself.
I'm in trouble.
Yeah,
Okay,
that's why I won't do your return.
because it was perfect, you know, for like I'd drive this old beater and, you know, it's like being in a car accident,
Yeah.
you know, kind of thing. All right, but no?
No,
All right.
so
All right, are we ready?
we're ready.
Bank charges.
Bank charges.
I knew the answer to this one.
Yeah, slam dunk. You know,
Yeah.
service charges.
Sure.
What about overdraft
Yeah,
charges?
bad fee, bank fees for the overdraft.
IRS says no.
I thought they said.
Now, I'd have to be a hard-hearted soul of an agent not to allow that. But yeah, the things that I've, the court cases I've read, and it can be substantial. I had one client, his manager was stealing money from him on top of it and didn't have enough money to pay the bills, but wrote the checks anyway, and had over $18,000 of overdraft charges in 1 year.
Wow.
Yeah, that's what I thought. But yeah, those are fine. I'd watch the overdraft charges. That they could disallow that if they look that close.
Could do so.
Usually not an item they're going to raise.
Hopefully not a big item.
Yeah, it
Yeah.
better not be. Yeah.
Yeah.
Otherwise, you need to get our managing your cash flow
Exactly.
session. So
And that is an indication that maybe your cash is not being, you may be the person managing, but it may be a real eye opener and red flag that somebody's not managing it well.
yeah, and sometimes you shouldn't manage your own.
That's right. Sometimes
Yeah.
you shouldn't.
Yeah.
If you're idea people,
Like Jim and I, the talent.
Like-
Yeah, we can't be bothered with that stuff.
just go fix it.
Pay somebody to take care of
That's
that.
exactly.
And not pay somebody to worry about
I
it
get
too.
Dr. John to take care of that stuff for me.
There
You
we
know,
go.
that's right. All right,
All right,
credit
yeah,
card. All right, it's my turn.
Moving
Credit card
along,
fees. Credit card
geez.
fees. Quick,
Oh,
jeez.
God.
All right.
Yeah,
Well, I'll talk faster, okay?
Yeah.
Credit card fees.
That's an easy one. You know,
Okay.
it's the charges that the bank's gonna, or the credit
your
card
ATM,
service, you know,
like your
the
ATM bank,
3%
yeah.
or whatever they charge, and that's fine, and that's automatically documented. So
And of course, in
that's
your retail, you know, they're charging your business that when your customer comes
Mm-hmm.
in and charges, they're running through, they're taking their money. The bank
Right.
is, right? Okay. Dues, fees.
dues and fees. This is where it sometimes gets a little cloudy. You know,
Yeah.
as your rotary and your lines
Yeah.
fees. Usually they allow that because you don't do it always for altruistic value. You do it for the business contacts that you
Business,
make.
social networking, yeah.
And so, for the most part, that one seems to be okay.
Is there a difference?
Health,
Yeah?
health club dues, no.
Oh,
Even if it's required by a doctor, you might be able to get it on your
Medical, but
on your
maybe-
Schedule A and your personal, but not in the business.
okay, now there are some kinds of what they call the Rotary Club, the Kiwanis Club, and the Lions Club. I believe those are service organizations. They
Yeah.
call them service organization. Elks Club, Moose, and there's a couple others out there. They're called fraternal organizations. Any difference that you know of?
Not really. I
Okay.
mean, except that the Elks and Moose seem to drink a lot more.
That was not true for those people of you that my clients that are in the Elks Club. That's a damn lie, Tom. Damn lie.
Maybe my sample size is a little small.
You shouldn't be hanging out there with people that drink. Wages and salaries.
As long as they're not family members,
All right.
it's no problem.
Okay.
Or yourself. Now, sometimes if you have a very profitable business and you're making very high salaries to you to maximize certain things like pension plans and stuff,
Okay.
or to get out, if you're a corporation, which you would take a salary, where you want to avoid the double taxation by taking dividends out of the corporation. The IRS says can come in and say you're paying unreasonably high wages to yourself.
Okay.
But you have to get really up there for this to be an issue, and our base clients, normally it's not ever going to be an issue. If it is, great.
And what you should take out of this is probably that if you're in that situation, you need to talk to somebody, because at some point the lines will cross and it will make more sense for it to be a wage or for it to be a dividend.
Right. Under current tax law, there are some advantages to taking out as a dividend and being double taxed on it, because the dividends are treated like capital gains.
And no Social
And
Security.
so,
Okay.
no
Yeah.
Social Security. So it works out pretty well. And analysis I've done isn't a whole lot of difference between the two of them under current law, but that could change and probably will pretty soon.
Congress will meet, the law will change. Yeah.
Yes.
There we go. Payroll taxes.
Payroll taxes, that just ties right into the salary and wages. If they adjust the wages, they're going to adjust the payroll taxes down, and so you have to go back and amend all your quarterly reports and stuff. More of a nuisance than anything.
And payroll taxes are how you define those?
Social Security, Medicare, employer
Medicare.
share, unemployment tax. I'll throw workers' comp in there because
Yeah.
it's more of a tax than an insurance.
I was just going to throw those in there. There's some hidden dingers in there.
Yeah.
Like, your Medicare and your deduction, and then and then your FICA, Susie and FUDA, and all those.
Yeah, all those.
Susie's a state unemployment tax. They would call it Susie. All right, repairs and maintenance. Here's a good one. I like this one. This is a good
this
fight.
one causes probably more problems than any other not more than
More.
but one of the major problem areas, because IRS looks at big repairs as something that needs to be depreciated, and small repairs as something that should be expensed. But they don't define what's big and what's small. Now, there's certain things, if the repair extends the useful life of the piece of equipment or vehicle, then you're supposed to depreciate it. Or if it adds,
All right.
But if it's just maintaining it to get through to the next year or whatever, then not. I mean, it's one of those things, no matter what you do, they could probably come back and overturn it.
They could.
But as long as it's the old piggy versus the hog
Yeah.
scenario. You Southern boys know that one.
We know that.
Yeah, you know that one. So, but anyway, as long as you don't get too over aggressive with it. Now, if it's not a vehicle, or if it's an over-the-road vehicle, it really doesn't have a lot of difference, because you can, and we'll talk about this a little bit later in the checklist, is depreciation. You can expense out under current law up to $250,000 of equipment. So it's kind of not an important issue as of right now.
Right.
But if we revert back to some
The
of the
old
older
days.
tax law,
Yeah.
it could be an issue.
It could be, and it
but just
could be-
remember, repairs and maintenance are
Yeah.
deductible as long as it's a business. Now, if you're taking your television in to get fixed, or if you're taking your personal rig to get in, have maintenance performed, that's not right, and that should be taken out as a personal expense. But if it's business vehicles, business equipment, no problem.
All right. Okay. And again, there's probably a spot where how you classify it might make a difference in some kind of advantage. So,
Oh, yeah.
I mean, you don't need to think about it. You might be able to justify them as either or both, and then you
Pick and choose to your
and
benefit.
make a
There have
smart
been
decision.
times I've expensed it, and other times where the client's had a really bad year. I go, maybe we ought to capitalize this,
That's right.
because we don't need the deduction this year. Why get aggressive on something we don't have to?
That's what
We'll
party
get-
animals like Tom sit up all night thinking about. I mean, okay, we're down to bad debts.
Bad debts.
Okay.
Now, if you're on cash basis, there are no such things as bad
That's what I
debts.
thought.
It's income that you haven't received. Now, I'll explain this till the day I die, and it will still leave my clients going, huh?
Yeah.
But what a cash basis taxpayer, which the vast majority
Which
of
I
small
am.
businesses
My
are.
business
yeah.
is.
It's income when you receive it, and it's expense when you pay it or incur a debt for it. All right? If you've never received it, it's never been income. So that when it goes bad, you've suffered an economic loss. but you've not suffered a tax loss.
We've been stiffed. We've been stiffed.
Yeah, you lost money, you're out money, but since you never recognize that income, now if you're an accrual basis taxpayer, which means you recognize the income when you make the sale, whether you receive the money or not.
Accounts
And that-
receivable. Your
account-
accounts
you have
receivable
accounts
are
receivable.
income.
Yeah. And which most people don't want to do because then you're paying a lot of income tax on stuff that you haven't received. But in that case, if one of those go bad, then you have a bad debt expense to the extent that
And that
applies
makes
to
sense.
that account.
And so hopefully you get back to the same spot, but the accounts receivable or the accrual basis is a little bit more paperwork, but that's
Right.
okay because it makes some sense for the people that are doing it. And they know, again, there's a line.
Right.
Okay, quickly, interest.
Interest. For buildings, equipment, anything that's used for the business, the interest portion is deductible no matter what. So,
Okay. All right, pension plans.
depreciation. You
Oh,
missed
did
a
I leave
line.
one out? Okay, we got it. And section 179. Oh, no.
See, you're going to blow my whole thing here.
okay.
Jeez, Jim. Depreciation. Now, once again, it's tied into this what's called Section 179, the ability to elect to expense that piece of equipment in the year of purchase. Now, I do that for equipment. I almost never do it for vehicles, even the ones that qualify, because, and I don't like to do it for equipment if you're buying it on time. I like to match the deduction to the cash flow. And if the cash is going out, then we take the deduction then. That's personal preference, and I explain it to the clients and let them, because the rationale is you take that big deduction one year, and then next year you're paying out all this money, and you get zero deduction. So all of a sudden you're paying what seems like paying taxes on the payments. It's kind of an illusion. But
Yeah, you get an
so that's
illusory
why
income,
I
yeah.
like to match
Yeah.
it up a little bit better than
Okay.
that.
And what is section 179?
That's the ability to make the election to expense it out in the year of purchase.
I knew that. See, I was just trying to point that out.
You're just leading me on,
Got it.
playing the straight man
Yeah,
here.
exactly. Pension plans.
Oh yes, pension plans. Fully deductible, long as
Okay.
it's a qualified plan. And there's several kinds for the self-employed person. There's simple plans, simplified employee pension plans. There's the standard pension plan and money purchase plan. I think
And
what
these
they
are
refer to.
employee match funds?
It can
or-
be either. Some of
Okay.
them, a couple of them are all the employer, and the ones like the simple plan and the 401k plan is a salary reduction and plus a small contribution or maybe a large one by the employer. So one of those things that you need to get with somebody, actually two people, your accountant and the financial planner to coordinate what type you're going to do, because you want to make sure whatever's going on in the tax return and the payroll reports is what actually is happening with the financial planner and where he's putting the money.
Okay, let's drop right down the end, work our way back up. Manufacturing costs, because we got almost no time.
Yes.
Do this last one.
I mean, the manufacturing costs, all those, if you're producing a product, or if you're a machine shop or you're a manufacturing company of some sort, all the things that go into that product, labor-wise, in the payroll taxes that are related to that labor, the materials. If you're just a resale shop, the cost of the materials, of the product itself and the resale.
Okay.
All those things are deductible.
We
So-
left out about 15
Yeah.
that we didn't get to, so including legal fees, one of my favorites, so, and accounting fees. So, okay. So thank you very much for watching the show tonight, and we'll be back soon.